Amin here from Sage Investors, and I'm here to do a quick mind map analysis of asset allocation growth ETFs. It's possible now for you to have a fully diversified portfolio of stocks and bonds by holding a single ETF product. And what these ETF products do is within it, instead of owning individual stocks and bonds, they actually own ETFs that represent different asset classes, and they are structured in a way that allows you to have specific weightings. And the way that the ETFs are sold, they're sold based on their weightings in terms of stocks and bonds. So if you wanted to have a portfolio that's heavily into stocks, you can buy a ETF product that will invest more in a group of equity oriented ETFs. So which is great. And because right now, for me personally, I'm looking to kind of build a little bit more exposure in my portfolio. I think my portfolios have too much cash in them, and I want to kind of build some exposure into my portfolio into equities and bonds without having to go out and figure out what specific stocks or which specific bonds I should be buying. I'd rather just own it through a low cost portfolio that just broadly invests in the markets. So you can do that through these asset allocation ETFs. And so what I'm looking at specifically in my case, because I want to have a really high exposure to stocks, more to stocks than bonds, that I decided to look for an asset allocation growth ETF. And often these growth ETFs that are out there invest in a ratio of 80% equities and 20% bonds. So I was looking around, see what products were out in the marketplace, and I came up with a few. And so basically I want to go through them today and kind of figure out which of these three would be an appropriate ETF that I could use in my portfolio to give me a much more broader exposure to the market, to both the stock market, as well as having a little bit of exposure to the income side of it too. So the three ETFs that I found were Vanguard has a product. They were the first to come out with these type of asset allocation ETFs. So they have one that's a growth-oriented allocation ETF, ticker symbol VGRO. iShares has a product also, similar product. And up here in Canada, Bank of Montreal, or BMO, has a similar asset allocation product. So essentially what I'm going to do is I'm going to evaluate these three ETFs and evaluate them according to a bunch of different criteria and see if we can figure out which of them, or if any of them, would make to be a reasonable an ETF to include in my portfolio to give me that broad-based exposure. So let's just pick it off. So let's take a look at now, when I'm looking at these particular ETFs, I'm evaluating by these various criteria. So what I'm going to do is I'm just going to go across the board here and compare the three ETFs based on these various criteria. So in terms of how these funds are managed, or how these ETFs are managed, first question I usually ask is, are these an actively managed ETF, in that there's a lot of people, buying and selling stocks and rotating stocks and individual stocks out of it? Or is it a very passive oriented portfolio, in that it is just passively trying to simulate exposure to broad market indexes? So for all three of them, they are all managed very passively. So I'm going to put a P beside all of them. So they're passively managed portfolios, and that feeds also pretty much into their cost, because if they're passively managed portfolios tend to carry a lower cost. So when I looked at the Vanguard MER, management expense ratio, comes in at 0.22%. The iShares ETF comes in a range of at 0.18, but when you factor in taxes and stuff like that, it ends up coming in around 0.2%, 0.20%, or 20 basis points. And finally, the BMO product comes in also with a cost, or an MER, of 0.20. Next, we look at liquidity. We look at what's the volume of trading that takes place in these ETFs. Ultimately, we want to invest in ETFs that are fairly liquid, have a lot of active trading going on, and a lot of shares that are being traded, because More shares that get traded means better price discovery, means when you decide to either buy or sell the ETF, you're going to get a pretty reasonable and fair price. You're not going to be subject to a lot of volatility in the pricing of the product. So when I looked at the Vanguard trades approximately 83,000 shares a day. Meanwhile, the iShares XGRO trades at about 42,000 shares a day. And then the BMO product trades in about 4,900 shares per day. In terms of the indexing, what are they tracking? What are they, benchmarking themselves towards? As I said, these are passively managed portfolios. So in essence, they're basically both. They're all essentially managing themselves or benchmarking themselves to the broad market indexes out there, all the way across. Another area we want to take a look at when we're looking at ETFs is the tracking area, is the returns that the ETF generating consistent or close to the returns of the underlying benchmarks that they're trying to track. Basically, we're looking for funds. We don't want to invest in an ETF that's leaving money on the table. That's essentially an inefficient ETF. When I looked at it, the funds don't essentially have a track. I couldn't find any really tracking error information for these specific ETFs. But as I said, these ETFs are essentially an ETF containing other ETFs, and they have much more detailed tracking error information. And what I came across was that across the board again, they all pretty much have low tracking errors. The returns that they generate are very consistent and close, or pretty close to the returns that the index that they're trying to replicate. Now, finally, the area that I wanted to really take a look at, because this is part of I think it's kind of the important part of it, is what is the portfolio makeup? How are these ETFs structured? Like, how is that composition? We know that they are all following an 80-20 stocks to bonds ratio, but what does that look like when you really kind of open up the hood and take a look at the details of it? So for the Vanguard VGRO, essentially their makeup is, they have, in terms of equities, let's take a look at the equities first. They basically have about 30% are going into the Canadian, and 70% are global focused. So of that 80% that is allocated to equities, 30% of that goes to Canadian and 70% goes to global. If you're to break down the global exposure, you will find, I found out that about 53.7% goes to the US, is invested in US equities. About 35.7% is invested in developing global companies, not including the US, and about 10% in the emerging markets. When we started looking at bonds, I found that the Vanguard tends to hold more, has more global exposure. Their bond ETF that they have has a much more global diversification. And also I found out that for my Canadian friends out there, that they are hedged. They're hedged to the Canadian dollar, which means if there's any fluctuations on the currencies out there, it's kind of hedged out there. So those currency risk that could be prevalent is hedged out, and so there's minimal impact on the overall returns of the portfolio through the currency hedging. It's quite common for bond ETFs to be, especially the ones up here in Canada, especially the ones with a global exposure, to be currency hedged. It's not an outlier. It's almost seems like it's basically a standard operating procedure for the bond components. So that's the Vanguard breakdown of their portfolio. Now let's take a look at the iShares portfolio. when we're looking at their equity component, they come out at about 20% Canadian. Oops, sorry about that. 36% US, about 20% international, and about 4% emerging market. Now the bond side of it, they own their 20% component in their portfolio is about 16% Canadian and about 4% US. And again, it's currency hedged. So that's the iShares product. And now let's take a look at the BMO product. Their equity breakdown is about 20% Canadian, 32% US, 20% international, and about 7% emerging market. And then finally with their bonds, it's about an 18% Canadian, 2% US. And again, currency hedged. So that's pretty. So there you go. So that's the breakdown. And I just also wanted to have explain a little bit of a differentiation here too. With the Vanguard numbers, I gave you these 30% Canadian, 70% global, and really I broke down the global to about showing what the 70% global exposure it consists of. It's about half of it is U.S. and about 35% is developing and 10%. So if you're wondering, like, how come this doesn't add up to 80-20, it's breaking stuff down even further to give you a little bit more micro detail of the breakdown of that. With the iShares and the BMO, I couldn't find this same kind of breakdown. Vanguard had a little bit more detailed breakdowns. Here, if you just look at it, it just basically all the exposure adds up to 80%. And vice versa, their bond exposure adds up to 20%. So show you a little bit of a differentiation and sort of how come the numbers may not jive with the total ratios for the portfolios. There's a little bit of difference. It's basically what I could get out of from all three prospectuses. So that's kind of the tail of the tape of these three ETFs. The question now is which ones stand out and look kind of interesting. So if I were to start looking at kind of breaking the stuff down, the fact that all three are passive, that's a good thing. We want, ultimately, I think we want as investors, I want to have as much broad-based exposure to as much of the to the market as possible. That's the beauty really of the whole ETF model, is having that broad-based exposure and having that broad-based exposure at a lower price. So when you're looking at these costs, 0.22, 0.2 and 0.2, they're pretty much in line. They're pretty much similar in costs. They're extremely cheap for these type of portfolios, and I think that's why a big reason why these portfolios, these type of ETFs have gained so much popularity in such a short time, is because you get that instant broad market exposure, global diversified portfolio exposure at a very low price point, and that's kind of appealing to people. When we're looking at liquidity, the frequency of trade, the volume of trades and transactions that occur with the ETFs, the Vanguard and the iShares definitely trade much more than the BMO. The BMO might be in early days because it's a very new product. It's very new in the marketplace, so it maybe just hasn't got the traction yet. But right now, if you're just looking at them, I would probably be more inclined to look at the Vanguard and the iShares purely because of the liquidity that occurs with it. All three have broad, have broad market exposure to the markets. They have very low tracking errors, so that's obviously another point. So that, so far, if I were to look at it, so far the Vanguard and the iShares seem to be standing out a little bit more than the BMO. So let's just keep going. Let's just see what further we can conclude out of some of these numbers. So if we looked at the Vanguard and let's look at in terms of the equity exposure. Excuse me. The Vanguard definitely seems to have more Canadian exposure. And it definitely seems to have much more U.S. exposure to also to the market. So if you're buying it, you're getting a much more. It seems like you're getting a much more North American focus in terms of your portfolio with the Vanguard. The Canadian, the iShares one has also the same level of exposure, but it seems to be. Actually, excuse me, I have it the other way around. It seems like the Vanguard has a much more international exposure compared to the iShares from that perspective. So if you're looking for a really, really more diversified global equity exposure, you may want to skew maybe towards the Vanguard product versus the iShare. If you want to have more of your money exposed to the North American markets, then your iShares would probably be a better bet from that perspective. But again, that's your preference as an individual investor. That's your preference. North American. When we're taking a look at the bonds, a bit of a differentiation here in the bonds in the sense that the Vanguard has more, there's more global bonds here. It has a more global exposure compared to the iShares. It's really a more Canadian, North American exposure on that side. So again, if your preference is to have a portfolio that's more globally diverse, it appears the Vanguard tends to, I think, would give you a more diverse global exposure if that's what you're looking for. If you're wanting to have a little bit more of a North American centric kind of exposure, then maybe you're going to probably have, the iShares product is probably going to be you're going to lean towards that to give you that more skewed exposure to the North American market. So that to me, it really seems to be different. The BMO one kind of is almost similar to I would say closer to the iShares ETF. I think the big difference for me really is just the liquidity factor. It just doesn't trade as much. So I would probably be more hesitant at this point to not go with the BMO product. My decision point would really be coming down to whether I want to have more global exposure in my portfolio or if I want to have more North American, more U.S. oriented exposure into my portfolio here. So that's really your trade-off when you're looking at these companies, when you're looking at these ETFs. So it's either your Vanguards or it's your iShares that look like the ones that I think will give you that seem to be giving the most broadest base exposure at the most lowest price and giving you a bit of liquidity in that sense. So that's what I got. That's been my analysis of a few asset allocation growth ETFs. If you're interested in more videos where I do these different mind map analysis, you can check them out on my website, sageinvestors.ca. And that's about it. So thanks so much for listening in. This video also will be available in podcast format, which you can download through Apple Podcasts and also through my website, sageinvestors.ca. So thanks so much for listening in, watching in. My name is Amin Reina again of Sage Investors, and we'll catch you again another time. Bye-bye.